battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name's Nick Stenger. We are Stenger Family Office for the past 45 long years. It's been our family's mission to deliver you clarity and confidence to help secure your financial future. Here we go. We're back at it. 217. No pain, no gain. It is true in the stock market. If you're not willing to accept a little bit of pain, you're not going to have any gain. So we're going to get into it. We got a bunch of charts for you coming up very soon. But before we jump in, I have to remind you about Tom Lee coming live, Investor Day, coming up very, very soon, October 8th and 9th in Oak Brook, outside of Chicago, about 20 minutes outside the city. You've got to be here for it. It is almost full. So typically we send out mailers and invites and emails and all the rest of it. We sent out one email. Thing is like 75% full now. So you've got a couple last chances here. By the time the second email goes out, it may be too late. So make sure you register. We are going to have producer Owen Katie the Greek are going to throw the link to register directly in YouTube in the description. So don't forget to click on register and come to Investor Day. Subscribe to the show, share it with your friends and family. Why? Because we're doing one important thing here on the show every week, which is keeping you on your plan. And right when all the client emails, calls, and texts come in and everybody's ready to panic, that's when I know we're close to the bottom. And I'm not calling the bottom, not saying 63.38 on the S&P was exactly the bottom, but I think we were pretty darn close. We have one client who every time they want to panic, every time they call in saying it's time to sell, that's when I know it really is the bottom. So they still have yet to call me. I'm waiting for the call, but that's when I know I should be buying because I'm just waiting for their call to come in. I know when it comes in, that is the signal. So we're not quite there yet. Could have a little bit more chop. We'll see what happens. This Iran thing is we're going to sift our way through this thing. We're not quite done with it yet. I don't think we're out of the woods completely. So we'll see what happens. We're going to show you a chart here in a little bit that's also going to show you that Q2 of the midterm cycle can be a little bit volatile anyways, so just be prepared for that. So let's jump into it. I've been showing you this chart every single week. If you don't mind throwing up producer O, the correction that started this year, 2026, in February is now only a 5.5% correction. Let's compare that to history. October of 25, February 25, March of 24, July of 2023, December of 2021, March of 2020, there's COVID, September of 2018, rate hikes, May of 2015, down 10%, April 2011, 15% pullback. Do you see the pattern? I'm going to keep showing this to you until the calls, emails, and texts stop, and you stop asking me, Nick, is this the end of the world? What am I going to tell you? I'm going to say, watch the data, watch the math, watch the statistics, get the data in front of you, and come back to the show every week because we are going to show you the numbers that really matter. Now, let me show you a number that really matters. April 9th last year, this was Liberation Day. You remember the bottom was April 7th and April 8th. What happened literally a day and a half later on April 9th? In a single trading day, the S&P 500 rallied 9.5%. That wasn't a week, a month, 2 years, or anything like that. That was a single trading day. This is not a statistical anomaly. This is all the time in the stock market. We have big days followed by bad days. We have bad days, a couple of down days, like 10% down, 5% down, followed by melt your face off days, up 10%. So that's why you can't time it. And this is that playing out. Here's my next chart for you. My next slide for you. March 30th, just a couple days ago, the S&P was down 9.5% from its all-time record high in the 6,300 point zone. Who told you that we probably would see 6,300? Tomorrow's news today, right here on the show. And what happened a few days later? Well, yesterday in the stock market, we were up 3%. Today, last time I checked this morning, we were up just under 1%. You've recovered 4%, half of the loss that you had on March 30th. You've recovered half of that loss in 2 trading days. This is why you have to stay on your plan. You cannot panic. The S&P was down 9.5%. Today, it's only down 5.5%. 5.5% is nothing. You're going to get one every single year. I got an email from a younger client in their mid-30s saying, Nick, I know you said we're on a long-term plan, but is this time different? I think we need to change our investment strategy, our portfolio mix. I said, if you're going to live into your 90s, you're going to experience 27 to 30 more corrections just like the one we went through. So I'm happy to take the call. I'm happy to take the email. I'm happy to talk to you about it. That's what we're here for. But what I'm going to turn you back to is the data. Get out of the narrative. Stop scrolling on Twitter. Stop going on your Schwab app or your Robinhood app every 2 seconds. Get outside. I had a client who just called me, said, Nick, I bought a puppy, the cutest golden retriever puppy, just loving it, taking the dog for lots of walks. It's a blast. Dogs got to go outside all the time. That's a good thing to occupy your time with. I would suggest get yourself a golden retriever puppy and get off of Twitter. That's the best thing you could possibly do for your portfolio. Best investment you could make. Buy yourself a golden retriever puppy and stop doom scrolling. Okay, here is my first chart for you today. Every midterm year is volatile. We just found out that we can actually zoom in here. Let me show you a couple time frames. I'm actually going to go over here. This is every single midterm cycle of the presidential election cycle. We've got President Ford there in 1974. S&P was down 35%. We've got Carter there in 78, down 15% intra-year. We've got Reagan. S&P was down 17%. Reagan 2.0 down 10%. We've got Bush the first time around down 20%. We've got Clinton there down 8. Clinton 2.0 down 22%. Let's go back. I'm going to go over here. Clinton 2.0 down 22% in the midterm cycle. Bush number 2, 1.0 down 34%. 2.0 down 8%. There's Obama down 17% and then 10%. Here's Trump, first time around, down 20% in the midterm cycle. There's Biden down 27% in the midterm cycle. The jury's still out here on President Trump 2.0, but the most recent correction was 9.5%. So the question is, do you or should you buy the midterm dip? I'm going to zoom in again here for you. Here's all the midterm election cycles. Here's the max drawdowns. So on the left there in the red, you're seeing max drawdowns intra-year, followed by 12-month forward returns on the S&P. What happens? You find that there is zero red 1 year out after the midterms. Absolutely incredible. Literally a 100% win rate buying the doom and gloom midterm news. In fact, the average intra-year correction during the midterm cycle is negative 16% on the S&P, followed by an average gain on the right there in the green of almost 40%. If you had these odds in a casino, you'd never leave. Let's keep going. This one's kind of funny. CNBC, every time they air this thing called Markets in Turmoil, a special that they run on their show, they tell you that the world is coming to an end, doom and gloom. Every time they air this thing on CNBC called Markets in Turmoil, and you bought the S&P, your average return, let's see what this says here, 5 years or is that 1 year? 1 year later, literally just 1 year later, your average return would be 40%. 100% of the time. Do you see any red on the screen? No, it is all green. What does that tell you? That tells you that every single time that the media tells you to panic is a buying signal. Okay, let's keep going. Here's another one for you. What are the underlying fundamentals of the market right now? Well, on that top line there, you've got EPS estimates. On the bottom is 2026. But remember, we care about 2027. That number there, I know it's hard to see, says $372 of earnings on the S&P. If that is correct and interest rates are still in the 4% range, because remember, we have to discount forward multiples by interest rates. But assuming interest rates are in this 3.5 to 4% range longer term, the fair value of the S&P would be $81.93. Let that sink in for a second. $81.93. Now, that's not the Stenger Family Office price target. Remember, we said 77.20 or 77.22, somewhere in there. We haven't changed it. We're not going to change it. That's not our price target. But the 81.93 is a longer-term number that we will hit. So the question is not, are we going to hit it? We're going to hit it at some point. But the question is when. I believe even if it's a year and a half to 2 years out, that is going to be a 24% increase just on price. When you add in dividend, even if it takes you 2 years to get there, the S&P's annualized return over those 2 years will be 12.3% per year. What's been the long-run average on the S&P 500 for the past 200 years? It's been 10%. Nothing out of the ordinary. So if you actually get your hands on the data, if you look underneath the hood and see what's going on in the U.S. economy, you're going to find that the current market environment is supported by earnings, and I actually think that earnings estimates are a little bit light, and you're going to see some ups and downs. You've seen the ups and downs over time. You've seen a bad quarter, bad couple of quarters. But over the long run, you're going to see companies become more profitable. Here's what's going on behind the scenes. We're going to do our little zoom in here again. Look at sales growth. Sales growth, earnings growth, double digits. S&P margins are some of the highest margins we've ever seen. 13, 14, 15% margins for a lot of corporations. Look at cash on corporate balance sheets here. Record all-time highs. It's not that these companies aren't going to go down. What do I always tell you on the show? We're not buying companies that are never going to go down. We're buying companies that can weather storms. How do they weather a storm? With a great balance sheet. Look at the cash on corporate balance sheets today. Look at margins here again. Some margins on corporations are approaching 20%. Absolutely outstanding. Look at buybacks. People sometimes don't like buybacks, but what is a company doing when it is doing a buyback? It's taking some of its stock off the open market. That's what Apple's done for the past 5 years now. Look at that stock. Absolutely incredible. Buybacks, dividends, profit margins, balance sheets are at record all-time highs. So yes, we're going to have a pullback. Yes, we're going to have some downturns. We could hit a recession at some point. In fact, we did hit a recession in 2022 that nobody wanted to talk about, my opinion, for political reasons. You're going to have those times in the market, but it's not a reason to sell and panic. Now, I'm going to give you the one doom and gloom thing just for Q2 here, and who knows what happens. This is just statistics, so we don't know exactly how this is all going to play out. But this is something that was pointed out here by the Carson Group. When you get into the midterm cycle and you look at the second quarter of that second year, it tends to be one of the most volatile periods in the cycle. So don't be surprised if we're not quite out of the woods yet. And this is what I keep trying to tell you. We may not be completely out of the woods on that 6,300 point zone on the S&P. I don't think we're going to fall much lower than that. Maybe we fall to 6,000, 6,200, somewhere in there. I don't think that's a high probability. That would still be a 10% pullback, which is very typical. Maybe we turn into a 15% pullback, but don't be surprised if there's just a whole lot of nothing in the second quarter this year. We just hit second quarter 2026. But look at Q4. Look what happens after you get past the midterms. 84% of the time, Q4 is positive. Absolutely incredible. So I'm going to close with two things. I want to close with Peter Lynch here, who is the absolute GOAT, one of the best mutual fund managers of all time from Fidelity. Here's his quote. He says, if you spend 14 minutes per year on economics and macro, you've wasted 12 minutes. Economic predictions are a total waste. Even the Fed chair doesn't know what interest rates are going to do, what inflation is going to be. How in the world would you and I know sitting here in Naperville, Illinois, or Spring, Texas, or wherever else? There's no way. So what's the antidote for investors? The antidote is to buy great companies and hold them for a very long time and think about your companies like I told you last week. Think about your companies like they're privately held businesses that you would only sell when you need the money. And that's the secret to success in the stock market. You invest when you have the money and you only sell when you need the money. You get on a goals-based plan, you have 3 to 5 years of cash for a rainy day. Everything else is nonsense. You turn off the noise and you move on. Let me close out here since Easter is coming up very shortly here. 1 Peter 1:3, praise be to the God and Father of our Lord Jesus Christ. In his great mercy has given us a new birth into a living hope through the resurrection of Jesus Christ from the dead. That's the message that we want to give you on the show each and every week. We want to give you a message of hope and optimism that the future will be better than the past. That's the whole message of Easter. So I hope you have a wonderful time celebrating with your family and friends. He is risen. Have a very, very happy Easter.